Good evening, good morning, good afternoon, wherever you are watching from, and whatever time you decide to watch this video. Hope you guys are good. Today we have a new session. We are going to be doing session 5. Okay. So again, welcome to the Institutional Prop Education. We are in session 5, and in this session, we will be going over market structure and Fibonacci. So very, very important. Up until this point, we have covered quite a few topics already. We had the introduction to market structure, and just for a bit of outline, market structure is basically the foundation of everything you need to know, okay? Including the strategy that I'll be teaching you throughout these sessions, okay? So market structure is the foundation. That is the basics and the advanced all together, okay? From basics, intermediate, advanced, market structure is the foundation. We always refer back to market structure, okay? So with that being said, let's get started. So today we're going to look at market structure in trends, okay? As the market trends, we want to understand the market structure, okay? So first things first, you're going to have to do a lot of this until it becomes second nature. So identifying patterns basically going up and down. So in an uptrend, make sure that you understand this, do it many, many times, backtest it on your chart so that you understand it. Today, we're going to go a little bit deeper into market structure, and this will be identifying market structure in trends. So what an uptrend basically looks like in a slightly more advanced perspective, okay? So in an uptrend, we know that it consists of higher highs and higher lows. And basically, in order for a new high to be created, it needs to break past a previous high, okay? That is one of the rules for a uptrend, okay? Now, in this case over here, we basically know that in order for the markets to change from bullish to bearish, it needs to break past a higher low, okay? That is the indicator that structure has now shifted, okay? So now we are looking at, as price basically goes up, it's never perfect, and sometimes you will get certain things that may confuse you, but just so that you understand, this is what structure will look like when it gets a bit complicated, okay? So as long as the higher low is being maintained, okay, and price is basically sticking around there, it can wick out, that's fine. It can go with a body out and back in, that's also fine. But the minute it forms and closes a new candle below the higher low point, then structure is broken. But you will get structures like this, okay, in this kind of model where you will see higher highs, higher lows, and then lower highs, but price still maintaining on that higher low point, okay? So price sticking around on the higher low point right here, okay, and not breaking below, because if it breaks below, it's a change in structure. Now, it can break multiple times, so it can break to come much lower, and it can break again to go higher. That's just something you need to understand, and you need to be able to read the markets and to understand what is basically happening within price, okay? So as long as the higher low is being supported, okay, then price will continue in the bullish trend, even though it is making lower high points, okay? So as price starts to create less and less, like once it doesn't create a new high and it creates lower highs, what we do is we focus on the higher low, because the higher low is the determining factor, okay? So we just have our lows over there. Price did not create a new low to the downside, so price remained in a bullish structure. So structure was maintained for this uptrend structure as the market kept creating new higher low points, okay? Each time higher low, higher low, higher low, and did not create a lower low, right? So let's look at an example over here. We basically have price coming from this sweep to the downside. We created a higher high because this high is higher than this one over here. We created a higher low and then another higher high. In order for price to go up, it needs to break past a previous high. So once it breaks up, we wait for the pullback. There we get another higher low point, and then price basically creates this new high over there. However, if you look at this low over here, okay, price did not break past, okay, because essentially that was a lower high point right here, and yeah, a lower high and a higher low over here. Very small, but it was there, okay? And you can see that price did not break beyond. We had wick touches, we had a candle body break out, come back in, and then more wick touches, but this uptrend was maintained the entire time. Then we created a lower high point over there. These are lower highs. And then we still managed to put in a higher low, and price continued to the upside. Okay, so very nice example over there. And another scenario that you may find is where price basically stops creating new highs, but the higher lows are still maintained. Okay, so structure was maintained for this uptrend structure as the market kept creating new higher low points. Okay, so we know that in order for price to go higher, it needs to break past a previous high. Other times you will find that price will rest on a high, okay, on a resistance level, and then continue to create higher low points as it goes up. Okay, so let's look at an example over there. We basically have this higher high, higher low, higher high over there, and then we had a higher low, another higher low, and another small one over there. But over here on the upside, this was basically maintained as just highs. Okay, so price just created highs, not new highs, not higher highs, but just highs. Okay, and maintain those higher low points. Okay, so structure was still respected as an uptrend, basically. Okay, so same thing applies in a downtrend. Okay, we understand the normal structure of a downtrend: lower highs, lower lows. Over here, we had a higher low point, but price was still creating lower highs. One thing to write down in your notes, and just to keep basically in the back of your mind, is just to know that what is keeping price in an uptrend is the higher lows, and what's keeping price in a downtrend is the lower highs. Okay, that's what's keeping price going down, and that's what's keeping price going up. Okay, so over here we basically had these lower highs form, and we can see that price was creating higher lows over there, but the lower highs were maintained the entire time. Okay, because if these get broken, then structure is changing. But if these continue to be respected, then price will continue in the overall direction, basically. Okay, so we can see that we did not create a new high breaking structure over there. It would have actually been over there, but price was basically maintained over there and continued to the downside. So structure was maintained for this downtrend structure as the market kept making a new lower high point. Okay, so let's look at this in an example over here. We have a low over there. Price basically pushed up, created a new low, created a lower high, as this high is lower than the previous one. And then we maintained on that lower high point. Okay, so there was some form of resistance over there. And you can see that price just put in highs, but not higher highs. Okay, and we continue to make lower lows. Okay, so price continued in this downward structure because our lower highs were being maintained. Okay, hope that makes sense, guys. Another example of this would be if price is creating lower high points and we see that the market is sitting on lows, so like a support basically. And you know, a lot of people like to buy off of support levels. Likewise, you know, they would sell off of resistance levels. Where's that other example? Here, people will sell off resistance levels. This is why you don't go for the generic textbook patterns, okay? Because in most people's eyes, this is a triple top, okay? And it is a good selling opportunity. But when you are reading structure and you see what is happening, you can understand that this pattern that everybody knows as a triple top is not a sell signal, okay? Especially if price is being maintained, okay? So what you can do in this scenario is, where would you enter the trade? So you won't enter anywhere around here. What you will do is you will wait for price to indicate if it's going higher or lower, okay? In this case, we had a break of the previous high, so we created a new high. Now, what we understand based on our rules is, in order for price to go higher, we need to break past a previous high. So we broke past the previous high over there. Each of these are highs. And then all we are doing is waiting for the retracement to get into a buy trade, okay? So same thing basically applies here also. People will look at these lows over here and see a triple bottom, okay? Triple bottom, and immediately they will be looking for buys. However, if you carefully analyze, you will see that the structure remains bearish, okay? And you will not be trapped by this pattern, okay, that everybody knows and everybody trades. So we know that in order for price to go lower, we have to break past a previous low. That is our low over there. Price breaks past, and what we're doing is we are waiting for the retracement and then entering the trade in this area based off of also structure and candlesticks, okay? That is basically how we trade continuation trades. So let's look at an example of what this looks like. We can see that price is basically trading down. We have lower lows, lower highs, lower lows, and then we continue to put in these lows over here, okay, because price did not break past that the entire time. However, it continued to put in lower high points, right? And then obviously there is the lower low. We wait for the pullback. We get involved in the trade. This can be also, if you find a nice area over here, you can see that the market fills that previous support, newfound resistance, and then sells off again. And I think it did continue to sell off from there. So I hope this makes sense. I hope you guys understand structure. I hope that, you know, because when it comes to continuations, everybody wants to catch the reversal. Everybody wants to catch the major reversal, the one that changes the trend and all of that. But sometimes markets can trend for days, for weeks, for months, and you can just be stuck trying to catch a reversal all the time, okay? You can get stuck trying to catch a reversal and the market can just eat your account up, okay? Because you will constantly be entering buys when the market is clearly selling. Whereas what you should have been doing was reading the structure of the market. When you read the structure of the market, you understand where the market is going, you understand the flow of orders, okay? And you know exactly where to enter. So if you see a continuation trade like this, all you are waiting for, based on the rules, that if the market is down, I'm waiting for the low to get taken out, and I'm waiting for a pullback. So you've identified your structure points, and now all you are waiting for is a pullback, and you find an entry from there. Okay. So next up, we are going to look at Fibonacci. Okay. Fibonacci, for those who don't understand or know what it is, we basically use this as a tool. So I'm going to get into what Fibonacci is, its origins, and so forth. But just for definition's sake, it is literally a tool that we use within the Forex market. Okay, we've seen it all around the world. We've seen it in nature. We've seen it in anatomy, everywhere. And also, this tool basically that was created for the Forex market, the way that we have deciphered the percentages and all of that, and basically put it into a tool. This helps us also because just as nature moves, the market moves, okay? So the market is a collective of everybody's input. Likewise, nature is a collective of all different types of molecules and this and that and whatever, and they all come to one consensus. So this is what helps us out. So let me just move this here so I can read. Okay, so Fibonacci. Fibonacci is one of the most famous names in mathematics. Fibonacci found that there is a sequence in everything, and literally everything, eh? So over here we have the numbers, okay? So by adding the previous two numbers together will give you the next sequence. So 0 plus 1 equals 1. 1 plus 1 equals 2, 1 plus 2 equals 3, 2 plus 3 equals 5, 3 plus 5 equals 8, 5 plus 8 equals 13, and so forth, all the way up into infinity. That is the sequence. Okay, Fibonacci number sequence is what constructs sacred geometrical patterns. Everything in the universe is constructed in a spiral fashion. So these numbers over here, you will see how it applies when we put it in a practical format, because yes, it is mathematics, but when you move it to a practical format, you actually see these patterns and shapes and stuff like that start to unfold. Okay, so everything in the universe is constructed in a spiral fashion. Fibonacci sequences are what construct nature and even the genetic and physical makeup of the human body. Okay, so this is what it looks like. Okay, and this is where the numbers come in. So we can see there 1 and 1, okay, equal 2, 1 and 2 equal 3, 2 and 3 equal 5, and so forth. Okay, so you can see the shapes. And as the shapes get added up and get basically made bigger and bigger as it gets added, there is a pattern that forms over there. So if you follow it with a line from the start all the way to the end, you get this curve, okay? And that curve continues as the number sequence continues, okay? And that is the spiral pattern that has been spoken about. So we see the spiral pattern everywhere. We see it in shells. When you open a shell, you will see it there. You will see it in a rose, a sunflower. The human ear basically has the exact same pattern. We see it in the weather. We see it in our cosmos. It's literally everywhere, okay? So when we are using Fibonacci, okay, we use it with percentages, okay? So we use percentages, and the main thing we are measuring, okay, with this Fibonacci tool, we are measuring the impulse leg of a trend, okay? Remember that we are measuring the impulse leg of a trend. Now, what is an impulse? I did explain it in the previous session, but I'll just go over it quickly now. An impulse leg is basically a move that happens sharply in the market, either up or down, okay? And usually this impulse is made up of mainly one type of candle. So if it's a bullish impulse, then it will all be bullish candles. If it is a bearish impulse, it will all be bearish candles. Now, I hope that you can see the lines on the chart going horizontally. And you will see on the top for fib for uptrend, you will see there's 0.00%, okay? And right at the bottom, you will see that it says 100%, okay? So in the middle 50, then we have my numbers that I've basically seen get touched more than any other number percentage, pullback percentage out there. I've tested so many things. I've even tested that golden ratio 69.8. Okay, it is too textbook. You do not want to use things that are too textbook, right? If everybody knows it, that means everybody can get tricked by it. Okay, so we just understand that in our impulse, okay, so we have our impulse over there, strong move in price to the upside, mainly bullish candles, okay, with the exception of one down candle over here, but it shouldn't break structure, okay, but mainly this is bullish candles, this is bearish candles going all the way down, okay. So over there, that is 50%. Now 50% of what? 50% of this entire move to the upside. That's 50% as price retraces. That is what we are looking to calculate basically, or finding the percentage of how much has it pulled back. Has it pulled back 50%? Has it pulled back 70%, 79%, 94%, or has it returned all the way to the beginning of the impulse, which is 100% retrace, okay? Likewise, in a downtrend, we are looking to see how far price has pulled back. Now, the minimum here is 50%. Why? Because 50% is either a discount or a premium, okay? In this case, as price is going up, it is becoming more expensive, okay? And when we pull back, when we retrace, when you come back to 50%, that is a 50% discount on how much price has moved up. Because if it continues going up, that means you bought it for 50% cheaper, okay? So remember, we're always buying low. So as it comes low, we buy, okay? As it goes high, we sell, okay? So in this case, 50% off, 70% off, 79% off, 99% off, and 100% off. When the market breaks past the 100%, the structure has changed automatically. Then it is no longer a bullish trend that you are following. If it breaks 100%, structure has changed to the opposite direction, okay? So I will get to how we draw this shortly, but just so that you understand, these are percentages, okay? And that is a discount. For an uptrend, it is a discount, 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 okay? In a downtrend, it is a premium, okay? Premium, what do I mean by premium? Okay, so if you are, say you started selling over there, you sold when price was high, okay? That means you got in at the highest price, and as price is getting discounted, you are now making money because you started selling it when it was high up, okay? But if you did not sell the impulse and you are waiting for a retracement, right? You want to catch it at a premium. So it won't most likely be 100% again, but you can at least catch it at a 50% premium, meaning it is now 50% more expensive than what it was here at the 0% when you draw the fib, okay? As it pulls back, it is now 50% more expensive, so you can sell it for a 50% profit, okay? Likewise, if it pulls back to the 70, 79, 94, okay, that is how much of a premium it has become, and you can now make money off of that. I hope that makes sense. I hope I didn't go too fast. I hope that makes sense, guys. Now, the Fibonacci should be drawn from a significant low point, okay? Now that the low point, which is Fib A, that is the start of our impulse, okay? Fib A is the start of our impulse, right? This would be a swing, right? So we are starting when you draw an Fibonacci for an uptrend, you start on the low and you extend it up to the high. You will always see me cross over like this. Why? Because we want to stretch out our Fibonacci, okay? To the next, dragged up towards the next significant high, which is our Fib B, okay? This is now in an uptrend. These significant points defined by candlesticks, candlestick formations at levels of support and resistance. Once satisfied with the AB wave of the Fibonacci, pull the tool over to the right-hand side to allow price action to play out. So you will click there and you will pull it over to the right-hand side so that there is space when the market starts to move within it so that you can see at what percentage it has come, okay? So in an uptrend, okay, we draw our fib from swing low to swing high. This is the impulse leg. As we're going up, that's the way you're drawing the Fibonacci, from low to high, if it's an uptrend. If you are measuring for a downtrend, you are measuring from the high to the low. Why? Because you want to catch the pullback. Okay, so if we look at this example over here, the market clearly turned bullish around this area, okay, right here. The market turned bullish over there. Let me get my drawing tool out so I can basically show you. So right here, right there is where price basically turned from bearish to bullish, okay? So we went from bearish, price shifted, okay? This was the market structure break, okay? Price went up, that is my impulse. So I'm drawing from the low to the high and I draw it out, okay? Why? Because I want to catch the retracement. So as price pulls back, we can see that we reached a 50% on our fib, and that now becomes Fib C. So from low to high is how you will extend the Fibonacci. Click and hold. When you get to the top, release, make sure that it lines up perfectly over there, and then you will wait for price to pull back. Once it pulls back, you will find an entry on either of these points. It can land anywhere within here, okay? Sometimes it even goes just before the 50 and goes up, but it returns to 50% and lower much later, okay? But just so that you understand how to draw the Fibonacci. Okay, so it's from swing low to swing high in an uptrend, okay? And this here will mark our break of structure. So you see that is the impulse leg. Structure wasn't broken because we will take the low over there and extend it out. And you will see that price did not break below with a candle open, form a new candle below that, okay? So break of structure, pull back, tap in, goes. Okay, that is an example on how to draw a Fibonacci retracement in an uptrend. Let's move on. So over here, we'll basically see the break of structure that I indicated. You will see price breaking structure, forming a new high, and then obviously coming back to the 50%, making it 50% cheaper, Okay, so if you look over here, this is gold. Okay, gold versus the dollar. You will see the prices over there. If we look at price when it was down here, we would say it's probably 1,765. Okay, so that's how cheap it was here. When it went all the way up, it was then, call it 1,875. Okay, over there. So as price now pulled back, we are getting it cheaper. We are buying in a lot cheaper, and that 50% lies around $1,820. Okay, so now it has been discounted from 1,875 to 1,820, and we buy that pullback. We are in there. This is a 50% discount on this initial move. 50% off. We get in, it's cheaper for us, we buy it up. That's it. So on a downtrend, we are basically connecting the swing high to the swing low, and that is our impulse leg. Okay, so let's look at what that looks like. In a downtrend, we basically got the high. So you'll see here's two bullish candles over here, but this one is much higher than that one. So we will take that one over there, and you basically draw it out. So the move is like this, okay? This is our impulse leg, and basically we are just looking for a retracement to get involved in the trade and then continue to the downside. Now, remember I told you about the 70.50 over there and the 79, okay? So these here, these percentages, I have found them to be so accurate. They are literally extremely accurate, and you want to write that down, put it on your charts. I think I got a screenshot of my Fibonacci settings. I will give you a moment to screenshot that, write it down, whatever you need to do. Okay, so that is what we are looking for, a premium, okay, within this discount. So as price was basically becoming cheaper, we understand that we need to sell when it is expensive. So as it becomes more cheap, we make money on the way down, okay? So we are selling it basically. So over here, you can see at the high over there, at the 100, we basically had it around 1,800 and probably 75 still, okay? Let's call it 1,875. Price pushed all the way down to 1,785, okay? And then as it became a little bit more expensive, we sold off here at 855, okay? And we sold it for a premium price. So it went from high to low, and as it came back up a bit, we sold it when it was at a premium price. And we basically made money as it got cheaper. Okay, so this is basically how we use the Fibonacci. All we are doing is calculating, or basically finding how much has price pulled back, how much was the retracement in percentage of the impulse leg, okay? So based on this impulse, how much percent did we pull back? Did we pull back halfway, 50%? Did we pull back 70%? Did we pull back 94%? Did we pull back 100%? Now, this 79 and the 70 over here, later on in the course, I will basically show you how this lines up with something important that we will always be looking for on this side, or basically on this entire side over here. Likewise with the 94%. So make sure you stay tuned for those videos, because these levels, the 94 and these ones, are not here for show. They are there for a purpose, and a big one at that as well. Okay, so we're just going to go through a few more examples. Let's have a look. Over here, we basically had our Fib A to B, okay? And then we found our C, okay? And as C was created, the new impulse, okay, so let me get my cursor out. Let me show you. So this was our initial one right here. This is the same one, okay? Impulse, pullback, impulse, okay? Made up of solid candles to the downside, right? So as that happens, okay, we have a new impulse. So even that impulse has a pullback, okay? Do you see that? So here we had fib A, B, C, and now C will become the new A for this move, for this impulse. Why? Because this impulse goes lower than the previous one. Don't forget structure. Lower high, lower low, lower high, lower low, lower high, lower low. Okay, don't forget structure. So if you miss the first one, you can always get in on the second one, right? That was our initial impulse. Now we have a new impulse. So our C now becomes A, like this one. Price pushes to the downside, and then we get our C again. On the pullback, we find that we are in the 50% premium area, okay? Price has now become a little bit more expensive, so we can sell it for a profit again. Do you see that? Okay, so over here, and we do it again. So that's literally it. A, B, pullback C, C becomes A as price makes a new low. So you would have already entered here and sold off, okay? You would have already sold off. And as you sell off, you will identify that, hey, my C is now also an A, okay? And now I can draw it out from A to B and wait for another C. When you get that C, you sell off again. Now there's another impulse. And you do that over and over and over again as price allows you to, okay? If we look at this over here, I just wanted to bring back this 38.2 level over here. Now, 38.2 does come into the equation. You will find where price will pull back to a 38.2, and you are more than happy to basically add this to your Fibonacci. You can add 38.2, it happens, right? Price does respect the 38.2, and usually when it respects the 38.2, it is a fast move out of there, okay? But the other thing that I've noticed was price will always come back, grab the 50%, liquidate anybody that got in on this fast move, liquidate them, and then carry on. I'm not sure if it happened in this when I screenshotted this scenario over here, but it is up to you. I just want to make it available to you as well. You can also follow the 38.2%, but this would be the first and the last time I speak about it. If you want to know more about the 38.2, I'm sure you can find information on it somewhere within YouTube. Okay, so just quickly, here are my settings for my Fibonacci. So I have the 0%. There is the 88.6. I don't always use it, but it is there also. You can use that just as well as the 38.2. But these are my settings. Screenshot it and apply it to your TradingView or MetaTrader platforms, okay? So as we go on within this program, I will be using my Fibonacci, and I want us to at least be on the same page when I draw my Fibonacci, okay? So with that being said, guys, that would be the end of our session 5. I hope that you guys have enjoyed it. Do stick around. Session 6 will be just as good. If you learn something, let me know in the chat section, in the comment section. I would appreciate it. Thank you so much for coming on. Thank you for your time, guys. Good night.